All right, guys, so there's a lot of stuff going on with the economy right now and a lot of changes, so I thought it might be good to focus back on the fundamentals of what a real estate cycle looks like. Essentially, a real estate cycle has four different phases. You have phase one, which is the recovery period. You have phase two, which is expansion period. You have phase three, hyper supply, and lastly, phase four, recession. Now, where we are right now in the phase of the real estate cycle can be a little hard to determine. So we use different metrics to kind of see where we are, what's happening, what's going on. For instance, in the recovery phase, which is phase one, we typically see a period where the demand is outpacing supply. So you're actually recovering. At this point, the supply, there's really no new supply coming on the market. You're recovering from a recession and you're starting to slowly see the vacancy rates decline and occupancy go up. So during this time frame, typically speaking, there is no new construction in a recovery period, just like there really aren't any new construction starts during a recession period. This allows us, the economy, to catch up because, basic laws of supply and demand. As supply goes down or remains stable in this case, and demand increases, then your rents are going to start increasing as well. So you're starting to slowly see a slight rental increase. And typically, recovery periods take a little bit longer. They tend to go up than they do during a recessionary period, which can fall a lot more dramatically. At the end of phase one, we now enter into phase two, which is expansion. Now, this is where the demand for the growth exceeds the supply growth. We start seeing new construction starts now because developers are looking at the fact that the demand is outpacing supply, and so we start seeing new constructions go out and rents start increasing even more so than during the recovery period. This period typically lasts anywhere from 2 to 5 years. Sometimes it can be even longer. Okay, so once you go through the expansion phase, then you start going into the hyper supply phase, because what ends up happening is with all those new construction starts, you have all these new properties coming on the market. It may potentially at a certain point outpace demand, which is the hyper supply phase. The demand supply equilibrium point is really kind of the meeting point in between the phase two expansion and phase three hyper supply. So when you're going into the hyper supply phase, essentially you have all these new construction starts. The demand is still there, but new construction is now outpacing the demand. So you're having hyper supply. At this point, you're going to start seeing increases in vacancy because demand remains stable, supply goes up. You have essentially increasing vacancy rates. In addition to that, during a hyper supply period, you have to start worrying a little bit about your rental rates because they are going to start falling at this point. Again, supply, demand. At a certain point, when your vacancy rates really start to increase and your demand is outpacing, or your supply has outpaced demand tremendously, you can potentially go into a recession, a recessionary period. This is where the vacancy rates go up, rental rates go down. Now, typically speaking, historically, recession is defined as 2 periods of negative GDP growth. Okay, you also start seeing a little bit more unemployment coming up. Interest rates. The Fed's going to start using money strategies such as raising their interest rates to start constraining debt and spending. This is all to check in the recessionary period. So you go through that phase as well, and then as you enter out of phase four, which is a recession, you enter back into a recovery phase. So this cycle repeats itself historically over and over and over again. It's just a proven cycle. Typically speaking, the cycle is anywhere from 5 to 10 years in length. Sometimes it can be a little bit more. Very rarely a little bit less, because it does take a little bit of time for everybody to start changing and moving. In fact, each one of these periods can potentially be 2 or 3 years itself. Your growth period, in the last, this last go around, in this last real estate cycle, our phase 2 expansion has been over 10 years. So it's even gone past the entire spectrum of what it would typically be through an entire phase. So we've really experienced unprecedented growth for the last 10 years. And then now we are in a situation where we have potentially, and this is partially for the pandemic, partially because of changing business strategies and needs, such as the distribution and the change over the internet and everything else. So we're seeing a lot more of a hyper supply now in this phase and going into a recession. What's an investor to do? Each one of these periods, you could potentially do different types of investments to mitigate risk and maximize your returns. For instance, in phase 1 recovery, a astute investor can make some good purchases in areas that typically have high population growth rates, so they're going to recover quicker. And by picking out the right properties, they can make above average returns during that whole time frame. Expansion, almost everybody tends to do well during the expansion period. You're buying, you're holding, you're leasing, you're getting it into that period. You're trying to create that appreciation. When you start going into the recessionary phase and hyper supply phase, this is where you're really going to start as an investor picking and choosing specifically what you're looking for. You can use different types of hold strategies, diversifying out on investments for 3, 5, and 7 year returns, so that you can understand, if we get out of the recessionary period in 3 years, it's here, in 5 years, it's here. So you're kind of mitigating your risk by choosing certain properties. During a hyper supply and recessionary period, some of the best investments can be core assets and stabilized assets, because those tend to be the assets that attract the most tenants and are typically very stable in the long term. Additionally, single tenant net lease investments that have a good corporate or investment grade guarantee and a long-term lease puts you through a lot of times the recessionary and recovery phase, and then you can then look to sell potentially in the expansion phase or to reposition your investments at that point. So each one of these does definitely have different types of opportunities that are out there for investors. Just because we're in a recession doesn't mean that investors shouldn't be looking at properties. Just because we're in a hyper supply, same situation. There's always opportunities out there. It's a matter of pinpointing the right properties for the right time. There's the old saying, how do you time the market? Well, understanding the market and the different phases of the market will help you potentially to time that market as well. The other alternative is just buy and never sell, and you never have to time the market. So as long as you have a good cash flow play. So ultimately, that's the real estate cycle. We can take advantage of it by really identifying potential investments for investors based upon the real estate cycle and add value that way. And if we stick to the fundamentals again, everything should be fine all the way through the next phase 4 and phase 1. So any questions? Yes.
Lots of opportunities for agents in a good market, which means a good economy. What opportunities do agents have during a recession?
Actually, I think there are more opportunities for an agent during a recession. You just have to be able to, and here's the reason why. During any recessionary period, even during a hyper supply period, a lot of agents get out of the business. The majority of the business that's done there in real estate, the old saying is 10% of the agents do 90% of the business, and it really still falls true. So it's essentially during a recessionary period, getting rid of the chaff, the agents that really aren't adding any value for their clients. They've been, all boats rise, with a rising tide. So they've been riding that wave for the last 10, 12 years, And now in a recessionary period, they don't understand how to adapt or react. So a good agent can identify, what are good investments during a recessionary period? What can we do? And actually convey that over to the investors. That's where we stand apart. Education and information and just really an understanding of the market will set you apart. If you add value, then you're going to be able to get more business. And with less competition out there, you're going to get that much more business. So I think during recessionary times and recovery times, and in fact, for myself, I've been fortunate enough to go through a couple recessions and survive them. But every single time in a recession, I've actually done better. We've had more business and we've increased the total deal volume size. Yes, Dave?
Can you correlate the economic phases with the stock market phases? Is there a correlation?
Pretty much all the same as far as, the stock market phases, and stock market's a little different because you have businesses that may really grow during recessions as well. There are recession, as they call them, recession-proof in companies, whether it's fast food, medical, things like that. So, it does correlate in the sense of the recession is the recession. That's what causes the recession. It affects the nation as a whole and potentially globally as well. Recovery phase also tends to be the same, where you're seeing growth again back with the stock market growing as well all the way through. So it does mirror very much the stock market cycles as well. Just the stock market tends to be a lot more volatile, and it can, same concept in the sense that during a recessionary period, a lot of people invest in blue chip stocks. They are looking at asset preservation. So same kind of concept where you're looking for long-term leases with credit tenants versus a blue chip company, so to speak.